Ralph Silva of Silva Research Network. Ralph, we heard from Ackerman saying we now need to firewall. This is something that actually a lot of investors, including yourself, have been saying for a very long time. He's talking about increasing the bailout fund to $2 trillion. Would they get the money? If they get the money, would it work? Markets seem in such a panic that it's difficult to understand actually what it will take to firewall these two countries. It's
interesting because what he's saying is two completely opposite things. If we firewall things, then we don't really need $2 trillion. Because if we firewall things, what we'll do is identify the banks that we actually need to survive, and we should make sure that they survive, and then identify the banks that we could let go under. And if that's the case, then we don't need $2 trillion. So what he's basically saying is we need both ends. We need security to have both ring fencing all of the problem banks, but also making sure we have sufficient money there. Why? Because he's making the assumption the economy is not going to recover anytime soon.
So this means that he's expecting a possible recession. What impact would that have on banks, and how do you firewall effectively? I mean, again, that $2 trillion seems like such a huge amount. You know, it took us a year and a half to get $1 trillion. So how are we going to get $2 trillion?
Yeah, I don't see where we're going to get that, and I don't actually think we're going to get that amount, simply because I think we are going to go into a recession because the bankers are telling us we're going into the recession. We've seen a few banks last week actually looking for enormous amounts of money, just in case. The whole mentality has changed. The economy's not going to recover next year. They're anticipating it won't. But just because they're anticipating it won't doesn't mean it will not. It may actually recover. And I think that's something that we all have to keep in mind. The benefit here from an investor perspective is there's a huge number of bargains out there. A lot of the banks, especially the top tier banks, are incredibly undervalued. And there is a huge buying opportunity, especially for the big banks, even the big Spanish banks.
European banks? So you mentioned the Spanish banks, yes. European banks, but also US banks? Give me some of the names.
Top tier banks, any bank that is extremely well diversified, both in products and geography, are really good buys at this particular time because they are considerably undervalued. The ones that are monoline, so if we want to talk about the Spanish banks, the small Spanish banks that are really only in property, very, very dangerous investments at this particular point.
But actually, Ralph, when are we going to see them fully valued? Because I guess if the situation gets worse, if a country leaves the Eurozone, these already undervalued banks will fall further.
That's right. And I believe that is exactly what's going to happen. We are going to see some of the banks actually come down, but we're going to see the top tier banks probably stay pretty steady. When are you going to be able to sell these positions and make money? Probably within 12 months, so it's not a really short-term investment, but banks never were short-term investments, so you should keep them for that period of time. But the big ones will probably pay off pretty well.
Are we going to see more job cuts and also streamlining? A lot of them are actually selling off assets to please the regulators.
And they're going to have to continue to do that. They're going to need more assets, or they're going to need more money simply because Basel III is coming into place, so they're going to start selling. The problem is this is going to be buying these things, so they're going to be sold at really bottom prices. And the other issue is that people are going to get laid off, not necessarily because of a recession, which certainly doesn't help, but it's the fact that technology has progressed over the past 4 years exponentially. They simply don't need as many people in the banks to do the same amount of transactions they did before. So why keep them on at an enormous cost? The economy just can't support that right now.
And now I want to focus in on the Spanish banks, because it seems that, you know, there are always two components on how to deal with these crises. A lot of market investors are asking for the new government to put in this bad bank. The guy in charge says actually he doesn't want to do that. Is this the only solution?
Well, it's not the only solution. The other solution, I think, is probably more appropriate solution, is to reduce the number of banks in Spain. We absolutely have to do that. Ironically, if you were to set up a bank, a retail bank today from scratch, you would actually use the Spanish banks as a model for that. They're incredibly well run, very efficient. The only problem is
not the cajas.
Even the cajas.
Even the cajas?
Even the cajas, very efficient, but except you wouldn't start a new bank in Spain because it's an economic problem there. Yeah. It's the fact that they just are way too leveraged within the real estate area, and they have to reduce that. So the solution is, let's reduce the number of banks in Spain by maybe 20%, maybe even 25%, and then the remaining banks will have sufficient business to be viable and to move forward. You can't actually play on efficiency there because they're already very efficient.
So, Ralph, what are the banks actually that you would let go? Is it some of the smaller cajas, or is it actually one of the big ones?
I would keep the big ones because of the diversification area. What Spanish banks don't have is diversification. The vast majority of banks are one product banks. In other words, they're mortgage banks, and we really have to stop that. The larger banks are well diversified. If you look at Banco Santander and BBVA, world-class banks, global banks, and extremely undervalued because they're being dragged down by the valuation of the smaller to medium-sized banks in Spain. So they're buying opportunities for sure.
But when you talk about letting a bank go, this has to be orchestrated by the government, and of course, you know, make sure that there's no run on the bank, because otherwise investors panic.
The key thing here is we don't need the banks, we need to save the banking customer. So let's let the banks die, but save every customer. Now, BBVA and Banco Santander would gladly take 20% more customers into their infrastructure, and by the way, be able to manage them quite effectively. So I think we're going to see what we've seen in the UK, what we've seen in France, what we've seen in other countries is forced mergers. Governments are going to come in and say, your customers are no longer your customers, they belong to here, you gracefully die.
Ralph, in terms of what we're seeing, there's so much concern out there from investors and also from just the man on the street and saying, where do I put my cash? If I'm taking out of equities, I'll put my cash in a bank. But do I risk a run on a bank here in the UK or elsewhere in the Eurozone? Are you concerned about this? Is this really a feasibility or is it just bonkers?
I'm not really concerned about that as long as you keep your money within your own country. I'm concerned about if you've invested outside of your own country because there's no real rules around that. As long as you have under maybe 50,000 euros within an account, it's going to be safe. And let's be clear. Throughout this entire crisis, nobody has lost money in their own country. Nobody has lost their savings. And I'm pretty certain that no European government would be the first to let that happen. So I think it's fairly safe that your savings are in a good position.
In terms of 50,000, so if you have more than 50,000, should you look actually at putting different accounts, and for example in the UK, to make sure that you're not in two different accounts, but that are owned by the same big bank?
That's correct. But also 50,000 is just a general number. In certain countries, it's a little bit different. But regardless, just never keep all your eggs in one basket, the diversification question. So keep it in 3 or 4 different banks held or owned by 3 or 4 different companies, and you should be absolutely fine. Again, there's no experience. Nobody's lost money over this crisis. Nobody's lost savings over this crisis. I don't expect that to change.
Are you concerned that we're actually entering a new phase in the banking crisis? I know we talked about it before, and you actually see it as an ongoing crisis from what we saw in 2008. Is this yet another hurdle?
This is a phase, and what I've seen change is the attitude of bankers. Whereas up to this point, they've always assumed the economy is going to recover in 3 months. Always 3 months, 3 months, 3 months. Now they've stopped that assumption, and we're hearing many of the bankers come out and say this is a prolonged situation. And I find that comforting. Why? Because they're setting up their banks to actually go through that prolonged area, and that cocooning of the banking infrastructure I think is very positive. And at the end of the day, we're actually going to have stronger banks because of it.
So do you think that they're actually just more realistic now? Was there actually a sense that just a couple of months ago they were trying to hide it?
I heard somebody say that I think that the banks were taking denial pills and they've run out of pills, and I think that's what it is. They've stopped denying the fact. When you have 5 million people unemployed in Spain, you have 2 million people in the UK, you have to be realistic. Even if the economy were to change tomorrow, getting all those people back to work and getting a positive attitude to them will take a year. So I think the banks are finally realizing that.
Ralph, thank you. Ralph Silva there, director of the Silva Research Network.